Benefactor underwriting for this broadcast has been provided by a grant from Republic Bank. The power of red is back. Major underwriting support for this broadcast has been provided by grants from New York Community Bank, M&T Bank, Perfect Building Maintenance, Customers Bank, Collins Building Services, Marks Paneth. Additional underwriting support has been provided by grants from AmTrust Title, Bank of America, Capital One Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC, Handler Real Estate Organization, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, New Banks, Meridian Capital Group, Ocean First Bank, RPW Group, TD Bank, the One Stop Property Group, and these friends. Oh, little crystal balls over there. Tell me what's going to happen in the investment sales business with regard to land. How can you develop property in New York City or in the metropolitan region if you don't have tax benefits, otherwise known as 421As? How can you develop with interest rates growing by leaps and bounds? I don't know the answer. So I asked my crystal ball to get in touch with Bob Knakal, the statistician, to participate and create a show on the topic. My guests today include John Catsimatidis Jr., Chief Investment Officer and Executive Vice President of the Red Apple Group, Jeremy Michel, Principal at TF Cornerstone, and last but not least, Bob Knakal, who is the Chairman of New York Investment Sales at JLL. So you're the statistician, you're the producer today. What's happening?
Well, Michael, the land market has been surprisingly robust, and I think if you look at the market today, investment sales in New York, different product type segments are performing very differently. Multifamily, surprisingly, is still doing very well, and the land market has had very, very robust activity, at least up until about a month ago. We're filming at the beginning of September. A month ago, with interest rates going up, it's changed the market. But if we look at the land market in New York, clearly the peak of the market was in 2014 and 2015. The land values hit their peak in 2014. The average land sale in Manhattan was $601 a foot. In 2016, it got to $662 a foot. And then the market started to decline as the entire market did. Land values so far in the first half of 2022 are averaging about $444 a square foot. That's up about 4% from last year. But I think it's going to be very interesting to see how the year ends up because of this downward pressure that's being exerted on values based on the disruption in the financing markets today.
So you're a developer. The majority of the properties you do, you self-develop. I mean, you've bought 2 properties in Williamsburg separately.
Recently.
Okay. What do you see? What can you do, especially with the fact that we don't have 421As anymore, okay, and as land prices are still continuing to be a reasonably high number? What is a company like TF Cornerstone doing?
Well, so we're doing a few things. One, thankfully, we have a robust forward pipeline of development. So we're heads down delivering product, getting those leased up, and completing our construction pipeline. That's going to take us a couple of years. Okay. The second thing is we're planning outside of multifamily. We're planning a very large mixed-use project, mostly office in Midtown.
Let's talk about that because that's an interesting topic. I think Midtown office is very strong. People want to be in Midtown office. The fact that the Long Island Railroad is going to be at Grand Central really makes a different thing. So tell me about what you're doing over there on 42nd Street.
Right, at the former Hyatt site, we're, well, it's currently a Hyatt, but we're planning to take that down and build almost 3 million square feet mixed-use development, predominantly office at the highest level of quality. It's a long-term project. We've gotten through entitlements. We're finishing up our planning. We're going to be into the market seeking a tenant to anchor that building. But we're still very bullish, and we have a lot of inbound calls, a lot of initial conversations that we were having with some substantial companies that want to anchor the property. So we're excited about the prospects, despite sort of the chaos that's going on in the office market by and large.
With regard to that, have you seen land sales, especially because of the rezoning approval, for the nonprofits in Midtown going up? I mean, we have a couple of buildings besides 42nd Street in Lexington. You have the Boston Properties building, you have the MTA building, and you have a couple of properties on Park Avenue where there's going to be development.
Well, there's a lot of activity. The Midtown East rezoning, in retrospect, was a great thing for Midtown. And it seems in the office sector that there is a huge difference between new construction office and everything else. They're almost two separate asset classes today. I think, if you built an office building on Avenue D, I think you'd get triple-digit rents today. So it's really been remarkable to see how the newer buildings have done well. There haven't been a lot of land sales for commercial office or hotel within the past 18 months. A lot of hotels, existing hotels, because of COVID, have been available for sale in one form or another, and at less than hotel land was selling for. You could buy the hotel per square foot for less than hotel land was selling for.
But with regard to that, aren't people buying properties, knocking them down completely?
Well, Michael, it depends on how big the existing building is and how much additional FAR you can get if you knock it down. But I think clearly there is a great opportunity for the city to do something smart, create a new version of the 421G that reinvented downtown to create all the residential. The C and D class office buildings are functionally obsolete. They're not competitive. There has to be a low-cost office provider, but most of those buildings should be converted to an alternative use with a very thoughtful 421G tax abatement type program.
Yeah, but
a lot of that could be converted to affordable
housing.
housing.
421G, which they did in Lower Manhattan, you're not going to really see this take place.
It's going to be difficult because if you look at a Class C or D office building, it's hard to justify paying more than $300 or $350 a square foot to convert it into an alternative use. A lot of the office buildings are worth more than that as office. Right. So you have to create an incentive. I've always told politicians when I talk to them, if you create the right incentives, the private sector will do anything you want them to do.
Okay, and you know one thing? 1,376 shows, never a politician. Okay? We've kept it as an alternative approach. John, let's talk a little bit about Coney Island. Let's talk about what you're doing on 8th Avenue, and then a little bit about Florida.
Sure. So I think a common theme amongst many developers, ourselves included, is that we're not only it's finding it difficult to find new land, as we've been talking about, but deferring existing projects, which is a result of a couple of different factors. Regulatory, as we've been discussing, is a big one, and also just the general interest rate environment and inflation within the trades is pretty significant. So it's caused us to have to go and look at greener pastures, as they say. We're currently building the tallest residential building in Western Florida in St. Petersburg, just outside of Tampa. It's a beautiful market, and we're seeing tons of people move there. It's lower taxes, beautiful weather. It's hard to compete with New York, but I would never bet against New York in the long term. But the pendulum will swing, but what requires the pendulum to swing is for all the market participants to be active in the conversation, talk to these politicians, and show them exactly what they're doing, because I think a lot of the regulations that they're putting in to lower rents across the board are actually doing the opposite of it. It's restricting supply. It's a fundamental misunderstanding of supply and demand. And I don't think that these politicians are bad intentioned. I just think that they don't have the full picture. So it's important for all of us to contribute to that conversation. But as you said, we're building on 8th Avenue and currently figuring out exactly what the format's going to be there. But that's an existing piece of land that we've owned for some time. And so the existing I think other developers are doing that same.
So besides 8th Avenue, you have a number of development type of sites like that.
Yeah.
Where else do you think you might build it?
So we have the ability to build 3 or 4 more buildings in Coney Island, but we're not going to pull the trigger until we have a more certainty around the kind of demand environment, but also the regulatory environment.
Have we seen a change in Coney Island with you and other developers? I mean, are you seeing other developers following your lead?
Yeah, absolutely. And you just have to kind of search on Google the headlines of all these other developers who are following suit, which I think is a great thing. Because Coney Island historically, as we all know, has been underinvested and is a phenomenal community and a beautiful area. And so with just some additional investment, there's plenty of demand for residential there and commercial. And there's also additional services coming online. The ferry is going to hopefully be coming online fairly soon, which is going to be a beautiful kind of transportation to and from Manhattan for commuters, which historically has been more difficult just using the subway.
Let's talk about Long Island City. You've been the kings of Long Island City for many years. Okay, let's talk about what you're doing in new developments.
Sure. Well, we're at the tail end of a big public-private partnership in Hunters Point South, and we're basically where we created 1,200 apartments, 60% of which are affordable units, and we're finishing up the leasing on that. We delivered that in COVID and have had pretty good success actually as the market strengthened, leasing that building up. We've commenced construction on the next project along the waterfront, which is 1,400 apartments in 2 sites that are going up simultaneously. And that's going to take us a couple of years to build. We're still in the ground coming out. We're vested in 421A, and we're putting the construction finance on now.
What about the retail? How's retail doing in Long Island City these days?
For us, retail has been doing just fine. For us, when we go into a neighborhood, we're usually going into sort of emerging neighborhoods, and we're putting in the right retail. We're programming the retail with all the right uses. We're not driving the rents on the retail. We're making sure that we're creating the right amenities for the neighborhood. As the neighborhood emerges, which it has on the first set of projects that we built, 7 buildings up in Queens West, the next turn of those retail tenants or when those leases expire, that's when we could drive rents a bit more, and we're seeing that. We used to have rents maybe in the $40s and $50 a foot, and we're clearly pushing well past that on the renewal. And now as we build the 1,400 units I just described, as well as the public-private partnership deal that we have in Hunters Point South, we're programming those units, those retail units with the right uses, and we'll see those rents strengthen over time.
What about schools?
The Long Island City waterfront, which is where we have most of our product in Long Island City, is rich in those types of public amenities. I mean, we have, maybe half a dozen schools, most of which have been built over the last,
10 years.
10 years,
Right.
Okay, all along the waterfront. There's one going in next to our building. There's one going in down the street where Gotham is building. Related had a project in Hunters Point South. There was a school there. So we're rich on schools, rich on publicly accessible open spaces all along the waterfront. We're putting in publicly accessible open spaces adjacent to the new 1,400 units that we're building. So, as far as public infrastructure, it's there, it's in place. It's now sort of building the community and creating a sense of place.
Yeah, and regarding what John said before about the ferry services in Long Island City are great.
Fantastic. We have 2 ferry landings, one on the northern end in Queens West, where we have the 7 buildings that we built, and one on the southern end on the waterfront, where we have the Hunters Point South project and then the new 1,400 unit project. So it's served actually by not only the ferries, but it's served by the subways, both in Court Square on Vernon Jackson, and the LIRR comes right into Hunters Point South. So it's like we're able to access both the local market and the region very easily.
Are you seeing foreign investors coming to the market for development, or they're
Well, Michael, foreign investors have bought a number of development sites. Again, going back to the peak of the market.
I'm talking about currently.
Currently, the foreign investors are not looking at as many development sites as you would think. There are developers that are New York-based that came from overseas, but I consider them New York developers. But in terms of foreign capital coming from offshore, it has not been that significant. In fact, there was a spike in activity in 2018 in land sales that was stimulated mainly by foreign capital. a lot of those sites are still sitting dormant today, and our developers who bought them are trying to figure out what to do. A lot of those have been owned by foreign developers. And so we're talking to a number of them today about what to do, where the market's going. Their value today is significantly below where it was. And so those sites are stalled, and a number of those are going to come to the market and may be sold well below what they were purchased for in 2018 or 2017.
Here's a question for the three of you. What do you think of new industrial in New York City? I mean, there's land limitation, first of all, and some of them that are being built are multi-level, which require extensive labor costs and construction costs, coupled with the egress to the property, to bring the truck up 28 feet over there is difficult. Have you seen?
Yeah, well, the multi-story industrial buildings that have been built have so far done extraordinarily well. And I think you have to have, in order to make that work physically, you have to have at least 4 acres of land. There aren't that many 4-acre sites in New York. And on top of that, there really aren't that many areas that are industrial zoned. So I wish that there was more industrial land in New York, because I think it would be great for the city. But that market is somewhat constrained just by zoning. And I think that there is a need for that quick last mile service, and those properties have done very well.
Here's a question. I was walking down Fifth Avenue the other day, and somebody said to me, "What's happening to the Lord and Taylor building?" Lord and Taylor building is supposed to be an Amazon warehouse. I believe part of it would be like the Orbachs, a warehouse and some office space over there. Do you see any other buildings like that maybe being converted to industrial?
Look, I think there could be more of them. I looked at an Amazon warehouse in Midtown a couple of years ago. The owner of the building was considering doing something with it, and I was shocked at their system. They have these what look like high school gym lockers with a variety of products in them. It could be a detergent, a hairbrush, a book, a number of 20 items in the locker. And I asked the manager who was showing us around, I said, "Is that an order that has to be packaged up to go out?" And they said, "No, we have algorithms that say when somebody buys detergent, they're 38% likely to buy a hairbrush. So we put these items together. So if someone orders 20 items, we go to 8 locations to get the stuff instead of 20 locations." And so I think with that technology as the basis for how they deliver stuff, I think they probably will have these all over the city. And with this, 1-hour delivery, 2-hour delivery lifestyle that we're getting accustomed to, I think they're going to do well.
Unfortunately, the 1-hour and 2-hour delivery, the GoPuffs and all of them are dying. They're not surviving in this world today. It was a nice idea, but people say, you know what? Why should I spend $30 for delivery, and I have no idea if they're going to be able to deliver because they don't have the right labor force over there. The city is 5 boroughs, and many people fail to bring up the borough of Staten Island. I recently did a show, and one of the guests said, "Staten Island, oh, that's a way to go to the retail shopping in New Jersey." So what about other boroughs? I mean, you've been Queens-centric and Manhattan-centric over the years.
I think over the years we were initially very Manhattan-centric. Half of our portfolio is still in Manhattan. We have a large concentration along the waterfront in Long Island City, but we've actually made a push over the last 5 years to expand into Brooklyn. We're building 800 apartments.
Right on Dean Street?
On Dean Street in the old Atlantic Yards, which we're going to complete this year. We bought 2 buildings in Williamsburg, and we own an asset in downtown. We built an asset in downtown Brooklyn about 8 years ago. So that's kind of, I think, where the future is for us, where we're trying to make a big push into Brooklyn.
Sean?
Yeah, I would just say commentary really quickly on the 1-hour, 2-hour delivery. We're also in the grocery business, so we have to compete with a lot of these folks ourselves. The way I phrase it is on this week's edition of when venture capitalists think they know better than operators. So it doesn't make sense at those kind of margins, and you're seeing a lot of these guys go broke.
They're all failing.
Yeah.
It's more and more.
And on the last mile front, I think we've all seen that the market kind of got ahead of itself during COVID because there was this massive pull forward in demand on e-commerce penetration for overall commerce. And now you're starting to see some of that fade away. So depending on your bullishness for e-commerce penetration over the longer time period, which I think most people would agree with, there could be a period of catch-up. But if you could find really interesting opportunities at a discount, then
So what are you
probably
looking
a good
for?
time.
I mean, you're the chief investment officer. I mean,
Yeah.
you're always been creative, the family and you. You were in the prop tech business. I think you're still involved with the prop tech business. What do you?
Thankfully, had a few exits before
Yes.
COVID and during COVID. But yeah, so one of the fortunate things about our business is that we're generalists and we're involved in 6 or 7 different industries and wholly own about 10 different operating companies in various different businesses. But at the kind of holdco level, we also have a fairly robust public markets investing group that uses insights from our private businesses to try to take large strategic positions in businesses. We actually think there's a pretty interesting opportunity in smaller REITs that are trading at a fairly large discount, which they've
Public
traded at-
REITs or
public-
private REITs?
Public REITs.
Okay,
that-
because
and-
they're both the public and private REITs. can
yeah,
work out.
a lot of public REITs have been trading at discounts to private market values for a while, and that disconnect is pretty wide now. And there's a number of these subscale REITs that have great assets, but just given the impending expansion in cap rates, are really going to have tough sledding ahead.
I have a question. What's your thoughts about SPACs in real estate?
We've stayed away from it. I don't have a really defined thought on it. We're a pretty conservative company and family, and so it's not really our cup of tea.
I know you've tried SPACs a couple of times.
Yeah, so we had a SPAC in SPAC 1.0 in 07, 08, and we looked at doing one again this time around, but we just saw this impending wave of capital that was coming on the market with not enough high-quality companies. And in hindsight, hindsight's 2020, but I'll tell you just in general, I think it's horrible the amount of SPACs that have de-SPACed with really kind of terrible businesses that have, there's no better term, but conned retail investors and made them lose 80, 90% of their money. It's really
when you see
disgusting.
that the latch went down to $1 a share, okay, it was $17. I mean, literally my crystal apples are no conceivable way to figure out. I stay away from this.
By the way, I happen to like I've known the Latch people for
I like
for
the
some
product.
time. They're great people. It's a great product, but valuations got ahead of themselves for
Right.
a lot of companies.
You know what a SPAC is?
I do, but Michael, I want to get back to the outer boroughs and the land market because we're talking about the land market today. I think one of the things that has been really harmful to the outer boroughs and land sale activity in 2014 through 2019 in the outer boroughs was fantastic. But this lack of 421A is really killing the outer boroughs
Without
because
the 421A, we're out of business.
no, because, well, not in Manhattan. In Manhattan, because every site can be a condo execution. But in the outer boroughs, we have clients coming to us today saying, hey, we want to sell our land. And we say, look, you're not in a condo location. Your site's too big, not in the right location to do condo. It's a great rental site, but you can't sell it today. We'll get back to you. Once a new tax abatement program gets brought into play, we'll call you and let you know. But the amazing thing is that politicians are often concerned about rents being too high, and they're trying to do things with rent regulation to make rents more affordable, but yet they cut off the supply of new units by not having a tax abatement program. It makes absolutely no sense. There's a giant air bubble forming in the supply pipeline because there's no tax abatement to get rental construction going.
Yeah, that's exactly spot on. And the other kind of sad point that's happening is a lot of what we've seen on the inflationary front in the supply chain is a result of energy and not necessarily the real estate market. It all sort of flows together, and now the Fed doesn't really have another option because the rest is up to Washington and Albany, et cetera, to pull any levers other than raise interest rates, which is going to really, really have a tough, make real estate have a tough time going ahead. So you also have the financing market for people buying new units going down, and you have to have cap rates go up, and rents are going to go up. So they're exacerbating the problem.
So where do you see as opportunities?
Well,
I mean, you have enough things in your pipeline for the next 10, 15 years. in
well,
certain-
no, actually, the reality is we have enough in our pipeline to last us for the next few years, and we're at the front end of all this production that we're talking about. And the front end means years of work to get through entitlements, to work, with the community and the local politicians to get the entitlements to ultimately be in a position, God willing, if there's a 421A or something like that,
Which
to be
I
able
think
to
there'll-
build.
There'll be one, but it's going to take time. I'm not gonna,
It's going to take time, and that's the question. So we're right now yes, focusing on getting our construction completed and getting our units leased that are currently in the pipeline, but we're also in the process of putting things into the pipeline that are going to take us a few years of planning and entitlements to get to the point where we could hopefully take advantage of a program and build, sometime in the future. And we have the ability to do that because we're builders and planners, and we're happy to take entitlement risk. But also, we have long-term capital and the patience to get to the next cycle or a cycle after that when the 421A is going to be available, hopefully.
John?
We think the public markets are really interesting, and unfortunately for the time being outside of New York, there's a few different kind of spots where we're adding to additional sites that we've owned already. But until things change, then I think that's where we're at. And I would encourage every single business owner and person watching this to talk to their local politicians and try to put some common sense into their heads.
Bob?
I think buying well-located properties near mass transportation in the outer boroughs is a great play, mainly because I think the city planning is going to have to increasingly...
So you're opening up your office in Staten Island?
No. I mean, look, we've done some work in Staten Island, not that much, but in the four boroughs, I think if you look at transportation and you look at densities around transit hubs, they're going to have to increase. City planning will continue. They've been doing it for decades. They're going to continue to do that. Decreasing density far away from public transportation, I think that's a good play. And I also think anything in well-located areas of Manhattan, if properties are not over-leveraged, I think you'll be great. I also would never bet against New York. I think it's the greatest place in the world. And I think that's where the opportunity is.
The reason we have the Apple is because we all love New York and we believe in it. I'd like to thank John, Jeremy, and the statistician and producer, Bob. See you next week.